Hello. Hello. Good morning. Welcome to another video stream of ES Futures Trading. Today is Thursday, September 14th. It is 8:30 a.m. Eastern Time in the US. PPI has been just released months ago. We got something. I think there is something going on here in this market. This market has good odds to come. I want to see what the market does with this spike. Again, the market has come back. It's trying to close. It's trying to close this gap, the gap that we have here. The base is very. The base is very questionable. No, it's very mechanical. Notice where this pullback happened in the overnight, right to last. Everything that happened here is, the market has good odds coming back to check this one. Now, that's not the interesting part. The interesting part happens, for me, is this: what can happen if, or when, or after this low, this pullback low is taken. Because right there, now we have this market from yesterday. Look at what happened yesterday. We have a big break in the overnight. Inventory gets very short. And what happened just after that, we have a short covering rally that fails, the market gets back into this spike. The lower prices, it gets back inside the spike, but it is rejected. It is rejected right away, and that could have been a good sign. But what happened afterwards is just we have accumulation here. This is short covering here. What we have here, short covering, and mechanical selling happening from this level here. Whatever this level is, the selling is very mechanical. The way how this market was sold yesterday is an indication that this is just short-term trading money here. Then the market take this out, these highs out. Taking these highs out, technically, okay. Technically, let me pull this. I guess I got a screenshot from yesterday. Okay, technically it repairs the spike, okay? It repairs these weak lows, but we don't have a spike here. There's still a bunch of stops here, up here. And why this repairs these highs, from my point of view, in my opinion, unless there's a spike here, there's still a bunch of stops here. I have seen this play before. And usually the market comes down, takes this low out, and closes in the higher, in the upper side, taking this back out. But yesterday, the short time frame traders got rewarded, okay? And that happens, right? Because short time retail doesn't always lose. If retail or short-term crazy traders will always lose, they will be in the market. So time after time they have a reward, and this was the case. I think that was the case yesterday. So this is the time when traders say, finally I figured out the market. Finally I started to win. Finally I have something, right? All my efforts are paying off now when I have this break here. But the last thing I wanted to be yesterday was short. And I leave this market when the market had this high and made this low here. No, this I don't want to part. I don't want to be part of this. So many times I have lost when I went short here, and the market just comes back with fury to the upside. That happens way more often than this part here. And but the context, right? You have short covering here. The contract. This is 2 more days to go with the current contract, and kind of like very, very, extremely weird things can happen in these markets now that the rollover is in process. And at the end of the day, something that you may have noticed as well is the volume is increasing, right? There's some steady increase of volume in the market, a very subtle increase of volume. It's kind of nobody. It is made nice and easy, nice and easy, nice and easy. It's going to the upside. It is low though, right? But it is remarkable how it's increasing. Something else as well from yesterday. It seems like the rollover process is over, mostly over, because look at this, what you have here. This is September contract yesterday, 600,000, very low, versus 1 million yesterday. And the remarkable thing for me is that the new one, I mean, the December contract has only 1.8 million. That's very low as well. I mean, this is the years, right? I don't give too much weight to that. Now, coming back, what I am very interested in watching or observing is how the market reacts around this level here. Because if the market takes this one, the relevant thing for me, is what the market did yesterday. The market, how to correct this? This is, what is this? It's 912 low. 912 low. What about this? This is 912. This is 912. 912. I'm going to call it questionable. Questionable high. For the reasons I have spoke before, because I believe there's still a lot of stuff here. What else? These highs, what the market did here at the closing, okay, because we have the rally high here. This is played rally high. If the market doesn't come back in here and starts building value up here, that's acceptance of higher prices from yesterday. Okay, from yesterday. This doesn't have too much weight now. This is because this is September content, but I want to put it here anyways. Late rally high. Late rally high. I want to see what the market does around between these two, this one and this one here. Because if the market takes this one and doesn't have any kind of spike or acceleration to the downside here, it confirms the rejection of these lower prices. But if the market comes back and starts building value in here, it will be rejecting this upside movement. Traders may want to follow what the market did here. The market went down. This is the movement that happened to the upside yesterday is quite different than what happened here. This is a rebalancing. It looked like a rebalancing at the time. This is a rotation. Right? The rebalancing of short inventory, and this is a rotation here. We may have an upside movement. The next thing, monitoring for continuation of the upside, this market is trying to close this gap. Let me put it here. Let me add more profiles here. It may take a little bit. Just so you know, Jim has a webinar coming here. Alright, you can register by clicking there. I'm going to do that right now. I have just registered, right? And this is the website you have open to go to the opener. I don't want to do this because it starts at 9 will give, when you hit this, it will, there's a voice there that tells you every minute, I think. There's the welcome to the webinar, all that stuff. And it's kind of like annoying if you are doing something. Alright? Just so you know. Okay. What do I do here? Okay, how do I move this? Okay. While I was talking, but where we were. Oops, let me check this. Okay. Just a second. I am doing something. Okay. Right. What the heck happened here? Why I don't have here this high here? This is questionable. Questionable. High. And this is questionable. Oh no, this is 912. This looks good. 912 low. Alright. Okay. What the heck is this? I don't know. Where was I? Oh, the next thing. Oh, we were here. I was opening this profiles here. The market is trying to fill this gap. It's trying to go. This is in the way, getting in the way. And these are, can you see how the references? These are references from the previous contract. So September contract. You can see this is 9.5 high, but that's not 9.5 high. Oh, no, that's it. This one, the next one, gap close, 3 days low. Alright. There's nothing here. This is from this one. 4600, that's the one, gap close, these are not. Ordinary distribution, so where is this 9.1 high? 9.1 high, 9.1 high. And this is 9.12, 9.7, 9.7. Well, never mind. The market is trying to close this gap. This high is quite questionable here. Notice this is a weak high. Weak because it's coming from a exact reference. To the tick is coming. It was sold from the low of the gap. This is a non-excess high. This is a non-excess high. This is non-excess. Non-excess highs are a sign the action has not been completed in the direction of the lack of excess, which in this case is to the upside. The overnight doesn't fix, that doesn't repair that. In the same way as this overnight session did not repair the extremely weak lows that we have here, this has not repaired nor this one. This has repaired this one, nor this one. Alright? Now, the next thing is a gap. The market has a gap now to the upside. Yeah? Notice this. We have 3 pieces of information in the direction of the current movement. We have the rally, the market is in the direction of the rally from yesterday. We have the market trading above these stops. Here, all the traders that get emotional here. Okay, the market is going to go to 2000 now. Coming from this mechanical level. No, this inventory is now underwater now. And there was a lot. Yeah. Now we have stops here. There's a bunch, there's a lot of trading here. How do you consider? If you have any kind of software that can give you something like this, let me show you something. This is you. Something like this. I know Sierra can do this, but there's also another platforms like Quantower that I know can do this. But notice how, for example, here, right? There's accumulation. This is the daily histograms. This is daily. All the volume accumulated in the daily is here, but regular trading hours only. Notice how this volume. This is the September code. That's how this really low volume here, right? Nothing here, nothing. 200, 200, that's nothing. Good volume is 10,000, at least 10,000, 20, 30, 40 are better. No? It's increasing a little bit, and this is when they start to increase. This is Thursday and Friday finally. Friday we finally have a good day here. And now Monday, Tuesday, Wednesday, notice how has increased. Boom, 35, 30, 45, you know. This market is going to the downside here, and volume is being accumulated. But notice where it is accumulated. It's in the upper side, in the upper side, in the upper side. And not in the lower side. Now we have something here, but this market just dries. I'm not saying nothing. I'm not saying the market is going to go higher. It's just observation. But what I want to show you is this actually. Can you see? Notice how the accumulation, how the volume is accumulated here. There's a lot of activity in the upper side. This belongs to this day. Okay? I should do this. What I do is the daily. I put the daily on the right side. Okay? The daily is on the right side. This is Wednesday intraday, and this is the total, the accumulation. I do that so I can have a fresh here on the front, in front of this one. I mean, that's how I get used. I like that way better. If I put this on the left side, I kind of like miss. I feel like I am missing something there. That's why. That's just personal choice. But if there is something to the upside here, all of this volume here is going to be the fuel for anything that happens on the other side. What else do we have on the other side? We have volume here, some accumulation volume, no excess here. Same thing goes in this day as well. Remember, there's only 3 days on December contract, but those 3 days have good volume here on the upper side. And there's no excess on the upside here, here, and here. And this day is also, this high is a bull high. Notice how it doesn't dry in the upper side. We don't have taper, like for example this is taper. This is nice taper. Coming down, just dries here. It didn't happen here. And on top of that, we have even more here, more coming here, more coming, more of all of this. Just add this one to this. And that's a new scenario that I am considering for today. There can be, there is something going on here in this market. Something might be going on. But I'm not going to up from the market. Right? I'm not going to up from the market trying to do anything here. If the market closes the gap here, that changes everything. Right? I will pay more attention. Closing the gap, kind of like, will make me question what can happen in the upper side. And we start monitoring value. If value builds down here or this part of the rally, as long as the market remains above this high, that will be good for the market. That's a positive sign. Against that, we have this low. Okay? So there's a lot of things that are going on here, and that kind of activity happens usually when we have these kind of markets that are very thin and just basically dominated by short-time frame traders. Today is the last day of June, so what I have historically, in my experience, is these days tend to be some very wide ranges, okay? Because if anything has not happened up to now we have all the fuel that we have here that we were talking about is in the market. You can go to the upside really fast, really quick, or you can break really far, really quick as well. I have no plans, I have set intentions to buy a call, for example, or to buy a put in advance of anything. I want to see what's happening, and if the market gives me an opportunity. Another way to trade this market can also be the SPY, right? You can, you can detach. Yes, I can detach this. I can detach this. For example, here, because I have the same odds for both sides actually. The 3 out of 4 highs are weak or poor, and 2 out of 3 lows are weak and poor. So we have this range. This is weak, weak, poor, weak, weak, poor, poor. Right? So it can go in any direction here, right? And what I have here, this is the SPY, right? This is less risk here, and I have this high, which is the gap close as a reference of 449, oops, and the lower is 44. So that's why I have this puts here, these calls here. I have zero intentions to do anything here. Alright? I have zero intentions to do anything, but I have this open here, just in case. Now, what the bond market is doing? Man, look at that. Whoa, it has a good opening here. 830, you know. It has this. What is this? This was the overnight. Was this the overnight? Yeah, that was the overnight. Look at that. This rally took all the short inventory here and then broke, and then he's taking. But there's a lot of games being played now. Just be very careful, okay? Be very careful. Don't get attached to anything here. You might be right in your observations. The market can be weak, can be low, whatever. But there's a lot of games that are playing this day. Okay? Irrational, unexpected things can happen today. It can be very crazy. Look at what happened here, for example. Oh, God damn. Just look at this. What the market did? Market has a spike to the downside. PPI, a small spike to the downside. Look what happened now. All of this long inventory was removed, and now it's getting long again. This low, this very, very mechanical low remains here. I am watching this. Okay? This could be a different day than yesterday. Yesterday we have a big spike. Now we have a low, relatively low spike, right? It didn't even take the lows of the overnight, but a really low spike. Now, if this big spike here has not been taken, or was not taken yesterday, of course this little one won't be taken. Okay? Try to get in the mind of the traders. Try to think, okay? Try to think what the traders are thinking here. That is another part. There is a moment, just like in poker, when you start getting a little bit more of information, that you don't care what cards you are dealing. Now you start play your opponents, you start play the players actually, and that could be, I think that can be something very useful. It can be very useful today. So just be very careful. Okay? Now, James is about to start his webinar. I always like to hear him, what he has to say. It has been very helpful for me, at least. Alright? The market has a range. 1, 2, 3, 4, 5, 6 days range. Taking this high is breaking out of the range. The next thing, monitoring for continuation, is closing the gap. If the gap is closed, the next reference in the upper side would be POC of this day. Okay. I don't have anything here. there's nothing clear for me in this market. Okay, but these days have been before for me have been kind of like hard as well. But I will post something on Twitter. I may not come back because I will be attending Jean's webinar. So I wish you a good rest of the day, a good trading day. Nice. Unless you have any questions, please just let me know. Otherwise, see you later. Bye bye.
Welcome to the webinar. Please stand by. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Everybody, thank you for joining us for today's webinar. Hello, Jim. Good morning.
Hello. Hello. So anyhow, as we always say, we do these in order to draw attention to the educational programs that we have. The next program starts, when's the intensive, Jim?
It starts on October 4th and runs through November 2nd, I believe it is. Hold on. Well, do you want me to show the screen, or are you?
No. That's
do that afterwards. Yeah.
But do remember that there is a prerequisite to the intensive. Prerequisite is that you have to have been to a previous intensive or completed the foundational e-course. We get numerous questions about people wanting to bypass the foundational e-course because they've used market profile in the past, but more than likely they haven't used it the way we do. The next thing I want to talk about this morning is, this always confuses me. My profiles are in two-tick increments. Now, historically, what I've said is, I'm in two-tick increments above 20 and single ticks below 20 on the
Sorry, when Jim says 20, he means the VIX for volatility. Okay? Just so we don't confuse folks.
I was just going to explain that. And the VIX is, extremely low. But I remain in two-tick, and the reason, it's a personal reason. First of all, I have another monitor. I have the other monitor on my right, and that is in single ticks. The monitor we're looking at is in double ticks. And the reason that I keep the double ticks is a personal reason that I handle the volatility better. The single ticks seems to get me a little bit more emotional, and the keeping it in the double ticks just keeps me calmer. So that's a personal choice. The most difficult thing currently is that I see absolutely no indication of longer term money in the market. Yesterday, I'm going to go to yesterday for a second, and I'm going to split out yesterday. You see the late liquidation. What this was the reason that happened. This was all retail traders. All retail traders, you say all, there's always going to be something, but predominantly retail traders. And if you've been with us before, you've heard me say that so many retail traders are undercapitalized and they cannot take trades home long. Either they don't want to, or in most cases, their clearing firm won't allow them because they're undercapitalized. So what you get, and they panic, they just keep greed trying to get this last tick out of this thing all day long. And if you look at this thing, 1, 2, basically 3.5 hours, it went nowhere. The risk of staying long is huge, but traders do it trying to get that last tick, and of course then when it comes close to the close, they're forced to liquidate. And when you have to liquidate that late in the day, there's no one going to buy it from you. And this gives you this tremendous liquidation. And of course, then the buyers, there were some buyers down there that took advantage of this. And of course, you see where we are today. But understand the difficulty in this, and understand retail traders, sometimes they don't appreciate the risk. They're so trying to get that last tick out of it, and FOMO sets in that makes it very, very risky. Now, we've got the same thing going on overnight. I'm going to split this out again. And the pullback in J period here was, it went a tick or two below half back, but basically, they're buying this at half back. Okay? I mean, so again, it's very trading money in here. Now the next thing, let me collapse this, I'm sorry. Okay, the next thing, so we talk carrying information forward. We have a multi-day balance. The top of the balance is the gap. On the 11th, the market comes up and taps the high of the 6th and also the gap. Right at this point in time, this is an alert that this is not a good high. It's a weak high. When it happens like that, mechanical sellers trading, selling at an exact level, or as we like to say, it's an anchor. An anchor is it's a psychological term that traders just decide that's of value. And it's a heuristic, but it's not, it's a rule of thumb that they do, but it really is nonsensical, but that's what they do. But the information this conveys to me is be very careful on the downside, because this, when you see this selling, this is not good selling. So you had no excess up here when you put these together. The following day, you had no excess. So this was a questionable, this whole area was questionable all the way through, as is the lower end of the profile. The lower end of the profile, we have non-excess low here, a non-excess low here, and another non-excess low here. This is also indicative, we have it on both the upper end and the lower end of the profile. This is indicative of a market that is being almost totally traded by the shortest of short-term traders. What I think is going on here is the institutional money, the larger money, really doesn't know what to do. They are just sitting on their hands. What they ideally, from everything I can ascertain, what they ideally would like to see is, a 10 or 15% break in the market so they could come in and buy. They're not getting that. And so they're not active in the market. So mostly it's short-term trading. This makes a very dangerous situation. So here we are now. It's about 20 minutes till we come in this morning. Overnight inventory is 100% long. Here's the settle, and we mark it from the settle. It's long. The last pullback, the last pullback actually was exactly at half back. I'm going to split this out again. I had the wrong answer before, but I just understand why. I said it went a little bit below half back. No, it didn't. It was exactly at half back. What happened is the range extension here changed half back, pulled it up. So this J period low was exactly at half back or within a tick. That is another indication that it's weak hand, short-term trading money buying. Now, as a short-term trader, and most of our clientele is, if you understand what other traders are doing, what your competition is doing, you can buy here. If you don't understand that this either works or it doesn't work, and you're either in or out, it either works or doesn't work. So if you know that this is what other traders are doing, and you can buy it. As soon as it gets up here, you don't want to fall in love with it. So sometimes it will continue, but from an odds standpoint, this is a very high odds position right now. Now, like I say, two traders buy this. One trader buys it just because it's half back, and that's what they do. Another trader buys it knowing other traders will buy it there, but understanding these are weaker hands traders, take what the market gives you, but don't stick around and don't fall in love with it. Okay, I'm gonna collapse this. So we're gonna open here in about 16, 17 minutes. Overnight inventory is 100% long. There's no excess here, and the market is aiming for the gap. That's what the market has in mind at this moment in time. Okay, I'm going to collapse this down again. Okay, so let me take a couple of questions, and then we're going to do a commercial, then we'll come back and talk more about markets. Okay, Jen, a couple questions.
Okay, somebody's asking, so what did you think of, what happened with PPI?
One of the things that I tell people is do not read or look at PPI. Simply look at what the market does. So the market went ho-hum. The market went ho-hum yesterday, and the market went ho-hum today. One of the worst things you can do as a short-term trader is take a look and think you're going to interpret PPI. Leave that to the market. Read what the market does, because we don't listen to the talking suits. I don't listen to them because they've got a different time frame in mind than we do. And the best thing you can do is look at the market and see what the market does with it. The market said ho-hum. The market said ho-hum yesterday, and it said ho-hum today. Okay, next question.
Okay, does Jim see an afternoon reference yesterday? Do you see any kind of pullback low?
No. The most important thing to me yesterday was that and it was just unbelievably slow. And it actually was a very rewarding afternoon, because I'm sitting there saying, we've talked about this. If you've ever been in our programs, we talk about this all the time. Late in the day, if the market's been slow like it was yesterday, and short-term traders, they just keep pushing, trying to get that last tick, and they're going to have to liquidate late in the day. And when they liquidate, all of a sudden, all the dickens break loose. This same thing, I've talked about this multiple times. This same thing happened continually on the floor of the exchange. When I was on the floor, you had the bigger traders in the crowd, and the bigger traders, and sometimes it was just one top step trader, they would realize that all the short-term traders on the floor were leaning the wrong way. And if they were leaning the wrong way, let's say like yesterday, they were leaning the long way long, all of a sudden the large trader late in the afternoon, and if you're on the floor, you put your palms of your hands towards the crowd, that means you're selling. And all of a sudden, they put their hands out and they sell. And they sell in size, and that just panics. That just panics the short-term traders, and it starts to feed on each other, and you got what you got yesterday afternoon. And you can get away with that when it's almost all weak hands traders. Next question.
Okay. Could Jim point out a few examples in terms of anomalies? I don't understand it, especially visually.
No, don't worry about anomalies anymore. Anomalies, we went through a period of about a year and a half or so where we had all types of anomalies. We don't have them we don't have them anymore. So let's just, I've kind of retired that concept. That was years ago, and it was when we were having big runs up and big runs down, and the market was leaving, strange anomalies. But we don't have them anymore.
Or better just to say you retired the concept because of other observations that,
Yeah, they just we went through a period where the market was very thin, but I haven't focused on that in years.
Okay. Okay, how do you deal with using 2-tick increments and excess? Does this not change, your excess minimum?
No, it doesn't for me. No, if I'm in 2 ticks, then my excess needs to be 2 ticks. Like I say, I have another machine now, another screen on my right, and I do have it in 1 ticks. in single ticks, just if I want to take a look at it. Okay?
Yeah, but definition-wise, either way, you have to have 2 ticks for excess. Okay.
And you don't want to be that exact. All right. Let's do a commercial. Jim, go ahead and take over, do a commercial, and come back, and we'll take some more questions and update the market.
Okay, sure. 1 second. Let me take the screen back. Okay, can you see my screen?
Yes.
Okay, so if you go to jimdaltontrading.com, I just want to point out for anybody who's new, you go to courses at the top navigation, and you're going to see that the intensive is featured up at the top. And we also have the schedule right here that you can download or open up just to see. Scroll down, you'll also see that we currently have limited time bundles. The bundles are going to be available through September 22nd. So as you heard Jim say earlier, if you're wanting to join us for the intensive, we do have the prerequisite requirement of the foundation and application of the market profile e-course. So if you have not done that course yet, you can purchase a bundle and you'll still get a discount for purchasing more than one course, and so this would be the correct bundle with regards to that. Our foundation e-course is, a little over, 11 or 12 hours, and it covers much more than what our legacy products do. So a lot of times I get asked, well, what about Field of Vision or Live Market Seminar if I've done that? I don't think I really need the foundation e-course. Can I join you for the intensive? The answer to that is that the foundation e-course covers more than what is covered in those legacy courses. And, legacy courses meaning that those are older. I would say also that the foundation e-course helps you on your learning curve because of the way that it's taught and organized in terms of the information as well. So if you have any questions, by all means, our email is down here at the bottom of our website, dalton@jimdaltontrading.com, or you can give us a call at 409-422-7250. And like I said, the bundles that we have that are discounted will be available through September 22nd. Okay? So let me give you the screen back, Jim. There you go.
Okay. And let me make one comment. Historically, we've always said that successful trading is a combination of market understanding and self-understanding plus your strategy. Historically, we have leaned more on market understanding than self-understanding. This upcoming intensive is going to be tilted more towards the self-understanding. Matter of fact, it's going to start off with a large discussion of book review and a large discussion of intuition, how you build and how you hone intuition. So this intensive will be quite a bit different than some of the ones in the past, simply because we're shifting the focus more to the self-understanding portion. Okay, a couple market questions.
Okay. Would you consider the weak highs as repaired or not because it happened overnight right now?
That question comes up all the time. No. Trading overnight does not repair them. Now, if we gap higher when we open, then they are repaired. Okay?
Oh, and something that I forgot to mention about the intensive, actually, and I'm reminded because somebody asked this question. From what I understood from your last webinar, this particular intensive in October will have more psychological discussions that traders face. Is this correct?
That's what I just got done saying. That's what I just said. The self-understanding portion of it, yes.
Right, and you'll notice also that the presentations are updated, or we have some newer presentations, as well as Jim wants to hit it early up front with regards to the psychological factors. So we're doing our book reviews, 2 book reviews early on, so that we can discuss that and then interweave that, hopefully throughout the intensive. Okay. Does yesterday's profile have a P formation with value yesterday being unchanged or overlapping to lower?
Yes, it does.
Okay.
But remember,
wait.
overall, you had a 6-day balance. You had no meaningful excess at the high. So many times people get too narrowly focused just on yesterday's profile. Oh, it's a P shape and values overlapping to lower. And that's right. But when I do my preparation at night, as I've said so often, I start from a bigger time frame up. I look at the monthly bar, the weekly bar, the daily bar, then I come down to the profiles. When I come down and say, okay, I've got a 6-day balance. There's 1, 2, 3, 4, 5, 6. 6-day balance. And I've got a gap on the upper. I have no excess on the upper end. I have no meaningful excess on the lower end. So I'm in there, and as I wrote, I think I did a report for there's 4 people that I talk with every day. And I just said, I came into today totally neutral on the market. Okay, what else?
Okay. You often mention signs of weaker hands trader in the market and how to identify them, but do you identify stronger hands traders?
Well, you do it by a process of elimination. When you don't have the indications of weak hands traders, then the odds are much better that you have stronger hands traders in the market. So it's a process of elimination. Yesterday, for example, when you watched yesterday, and it just, goes to these exacting levels constantly, that's just a sign of weak hands in there. So when you don't see the market going to these constant, mechanical references, then that's an indication that you probably have some other participation, and that participation can be all over the place. I mean, it can be CTAs, and CTAs a lot of them act a little different than do hedge funds and do longer term money. But basically, when it's yesterday was just unbelievably slow, mechanical references, that's usually a sign of very short term traders. Okay.
Okay. Do you evaluate volume profile and market profile or separately or concurrently?
I don't use volume profile, although I am adding 2 of the VWAPs in the next seminar. As I've said so many times, historically, the weighted averages, volume averages, were indications that are used by institutions. And it does give you some idea of institutional money in the market. But the volume profile in and of itself, I don't use, although I am mixing more with the 2 other indicators. Okay, what else?
Okay, when you get a contract change, do you have the previous reference points, like for example, singles, POC, the settle from previous days? They're asking basically remember, how do you handle that for the references?
The December contract's been trading for some time. So you're looking at the December contract here, and I just, I've had the December up, and I'm using the references off of December trading. I don't mess around with the roll or anything else. It just gets too confusing.
Right. So generally speaking, if the contract rollover just happened, depending on what Jim is doing, if he's in a trade, he may still have the prior contract because it's still trading. But once it's beyond a few days or whatever, usually he's on the new contract then. I know that sounds a little bit confusing, but that's how that is. Yeah, because another question is, how does Jim trade rollover, or does he? Because for me, it doesn't make sense for a couple of days when the rollover happens.
No, like I say, I just go to December. When it starts to get, because look, December's been trading for, this December contract, it's been trading for some period of time, and there's been, there's been.
No, rollover happened on Monday, Jim. Rollover happened on Monday. So, if depending on what's happening or, the volume trading, Jim, if he's got some trades on, he might still be in the prior contract. But otherwise,
but I've had the
yeah,
December.
if he's got the option.
There's been enough activity in the December contract that I've had that up for some period of time. I may switch and go look at the current contract. Okay?
Right. Okay. Given the size of this gap up, where do you put the probability of large liquidation at the open?
I don't have any probability. I just look at the market and see what the market does. In here, the overnight inventory is 100% long. The gap was not filled. They got the stops. The market went up. There were some stops up here. They got some of those. The odds are always very high that you're going to get a counter auction relative to overnight inventory. They're about 70% overall. Additionally, remember this last rally came from exactly half back. Now that changed when you got the range extension, but this is not strong from what I can see. But again, you had no real excess on the high, and you still don't have any excess up here. Okay, final question. Jen, are you there?
Okay. Yes. So with regards to, the balance, somebody mentioned that they see that it's between the 50 and the 100-day SMA. Do you consider that in itself another form of balance?
No. I just look at the profiles and, I just see what we're dealing with now. You looked above, well, we'll see. We've overnight, we looked above the 6-day balance, but this is a go, no go level. Do you look above the balance and extend to the upside? Or do you look at above the balance or at the top of the balance and fail and begin a rotation lower? So this is the key level up here is seeing what happens right here at the high of the 6-day balance. This is what I call a go, no go level. The gap is the main upside reference for this morning. All right, let me say thank you very much. Have a great trading day, and I hope you join us for one of our programs. Bye now.
Thank you, everybody. See you at the next one. And if you have any questions, don't hesitate to contact us at the email at the bottom of our website or the phone number there. I'd be happy to speak with you. Thank you.
Oh. All right, that was Jim. That was Jim's webinar. And this is, man, I hate this kind of days. The market is in between two gaps here. Market is trying to close the upper gap here, the upper side, while it's gapping to the upside. So it's in between two gaps right now. This is crazy. And as he said, this is just a sign of who is here, who is doing the trading here. All right. Look at this. Look at this setting. I mean, this is the new contract is not charging. God damn. Look at that liquidation. The market closed the gap right. I mean, get back inside the range. Get back inside previous range. It's like 6-day range. But this is a big but. This gap remains. This market is buying from this high here. If there's some serious selling pressure, the market will not buy, will not stop here. Just come back once and that's it. So the fifth sign, the market has come back inside range, alright? Market has come back inside range. Let's see if the market closes this gap in the lower side. This can be a counter action to the overnight inventory here. Okay, he's coming back to this to check this high here. Let's see if it can come back here. Oh, come on! Oh, God. Damn it. My chart just closed. Hate when these things happens. I guess I have too much. I guess I overload my chart. And I did not save it. God damn. I hate you, photon. God damn it. Okay, I'm gonna open only once here. It was logistic data. Come on. Hurry up, hurry up! Oh, the market had come back inside above this line. The gap remains. Can you believe it? This now is not this reference. This reference here now changes, is now gap closed. Gap closed. Remember this reference here. This was held back. This could be just a counter-action to overnight inventory. Remember, the market has a gap to the upside. This could be we can have some serious buying, really fast buying here. If volume doesn't start building to the lower side, this can be really fast and can go really fast to the upside. This is an upside market, okay? The goal, I think the market is trying to close this gap in the upside. But the structure is very weak. Remember, where it's coming from is this thing here. We have this weak pullback. Boy. What the heck is this? And these two pullbacks, very questionable pullbacks here on the lower side. So we can interpret this in several ways. We can say, okay, the breakout to the upside has failed, part of the gap has been filled, this stops has been taken out, the market has failed to the downside. That's one interpretation. The other one is, there's change here in this market. One time frame lower has ended, there's a breakout this day, you have a gap to the upside. So which one is going to be? Let the market settle. I have made a couple of trades here already, but let the market settle. Do as I say, not as I do. Okay, the market's tend to come back here. If the market doesn't come down here, probably we're going to test the highs. Try to close the gap now. The question is which gap is going to be closer, the upper gap or the lower gap? This market's right there, building value here, right there at the center of the gap. You can go in either direction here, either direction. But there is change in the market, okay? A gap to the upside in this case is a sign of change. The market has changed here. It's kind of like a little bit long though. These short corner rallies can be vicious, man. These ones can go really fast. Boom, a big spike, and just trigger some serious buying here. Yesterday there was a gap as well, I think. Was that a gap yesterday? No, it wasn't. The market opening inside. Okay, market opening inside. There's the range. The overnight has a big gap. That was a big spike to the downside. That spike was rejected. Let's see if value bills, some reds start to appear here. That would be really nice. Oh, nice. We have some reds here. Some reds here. Boy, who's coming on the lower side. Volume is coming here. This maker is trying to close this gap, man. Yeah. This thing, what the heck is this? This looks like a counteraction. Remember, this is a pullback right to half back, and this is the base of the spike right here as well. Oh, this is a nice taper here. Notice how it dries here. Mixed readings, yeah. No, the market seems like not going to attempt. Oh no, this is setting from this high here. Let's not go now. It's another attempt. This attempt to close the gap is coming from this high, which is also half back, which is questionable. Very, very questionable market here. In the same way as this high here did not repair this bunch of highs, technically have exercise, the same thing is happening here. Technically this is good, but the stops from this day and from this day are still here, and to these stops, more stops have been added here. More stops have been added here. Now, market is coming back to this level again. Let's see if more reds appear here, or it just rise. Or it's bought from here. The gap remains. There's a gap here. It's still there. Volume. It's a little bit, I guess. We can have some volume here in the upper, some volume here, different than yesterday. The question is which gap is going to be filled. The upper side or the lower side? Remember the week now how good volume here, Monday, Tuesday, Wednesday. This volume is short. So we have shorts here, longs here in the overnight. So more volume to the downside, more shorts here. What kind of shorts? More likely short time frame shorts, very short term trading shorts, very weak shorts. Now let's see what happened with this level here and this one as well. Doesn't have the strength. Seems like it doesn't have the strength. Look at where it's being bought with. Like on this level here. Okay, I want to see some reds here. Reds, not just whites. If it's white, I will need to do a bunch of whites here, and reds appearing somewhere down here. But this it doesn't have, it just dries there. Again, coming back to that level. Another attempt. Notice how this dries. Now it has a better shape. It's really nice dry here. That's taper. Okay. Now we can rally now. Okay. Another attempt to close that gap. It doesn't come lower than that. It doesn't come lower than that, man. Come on. It doesn't have a sentence, don't it? It is a nice taper shape, but if there is some reds that come here, be aware, watch out, okay? Watch out. We can have a huge rally here, a big break closing towards the lower gap here. Now it did not have any acceptance that time. So far. the market can, the way how this market has been traded, the market can come back right to this level and be bought from here again, over to here. Downside continuation, we'll see the market closing the gap. First, coming back inside this range, then coming back inside this one. The next thing, coming back inside this range from this day, but has to take this level first. Probably, oh, POC is inside this range. Oh, yeah, yeah. It's so slow, man. So slow. There's a lot of buying here that's going on. The pressure to the downside. I think this always, the pressure to the downside towards this inventory. There can't be this inventory here. The market's trying to close this gap here. Alright, we are almost 10 a.m. If you have there's any questions, I'm going to call it a day. We'll see you tomorrow. Bye.